Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, December 8th, 2021, and I'm pre-recording this Trading Places Live for Thursday, December 9th. Futures currently, they were down for a bit. They've now turned a little positive. Of course, things can change overnight, but currently we are showing futures up just slightly. NASDAQ futures seem to be up a little bit more than the others, up about 15 points. We got Dow futures up 28, S&P up 3.5, but NAS on a percentage basis up slightly more. So maybe that sticks. We continue the winning streak that we're on right now. Market has been pretty solid of late, but we do have a big inflation report. The CPI report comes out on Friday morning. So that is something to at least keep in the back of your mind as we move toward the end of the week. First, let's go ahead and go through the agenda for today. We're going to start off with the daily market recap, as I always do, and jump into talking technically. I got a couple of industry groups I want to point out, go through, talk about a little bit. Then we're going to look at an RRG chart. I haven't done that in a while, so I think you'll like that, the way I take a look at it, so stick around for that. Then we'll get into the earnings spotlight. Still got some companies coming out with earnings. Going to take a look at relative strength a little bit, maybe talk about how we can hopefully predict sometimes the way some of these companies are going to report. And then we'll wrap up the show with the three you must see. Let me go ahead and get started. First, take you over here to earningsbeats.com. This is our website. If you're new to Earnings Beats, you can try our service. We have a 30-day free trial. You do have to give a credit card for this so we can get you set up on our system, but it is completely free for 30 days. And then if you decide you want to re-up, then of course you would have fees going forward. But again, 30-day free trial, you can try our service. If you scroll down, if you're new to Earnings Beats and you simply want to find out a little bit more about what we're all about, then I think you could take a look at our Earnings Beats Digest newsletter. All it takes is a name and an email address here. Hit that subscribe button. No credit card required. You can unsubscribe at any time. I publish this newsletter 3 times a week. It's very brief. We're talking a couple paragraphs in a chart. Mondays, Wednesdays, and Fridays, usually out about an hour before the market opens. But I really focus on relative strength, earnings, gaps, candlesticks, just anything that I think can help our community trade a little better, a little smarter. That's what I tend to focus on. So if you want to learn more about us, this is probably the best way to do it. Sign up for our free Earnings Beats Digest newsletter. All right, let's move on to the action from Wednesday, because it was a pretty good day. Dow Jones Industrial Average up 35, S&P 500 up 14, NASDAQ up another 100. So on a relative basis, this was your winner, up almost 2/3% today. So it was a little quieter than what we've seen recently. We had the big down moves, big moves back to the upside. We've had several days of late where all the sectors have either gone up or gone down. Well, that all changed today. We didn't have nearly as much volatility. Mid caps, you can see up a little more than 0.5%. Small caps also about 0.5%. So across the board, very similar type numbers. But among the sectors, it was really mixed. Didn't have any huge winners or any really big losers among the sectors. Nothing up or down more than 0.75%. Healthcare, the big winner on Wednesday, up 0.75%. Communication services, almost 0.75% to the upside. Financials, surprisingly, have not been doing very well on a relative basis to the S&P 500. And the reason I say that's unusual is we've been seeing the yields moving back up. Normally, when the yields move up, financials lead. That has not been the case. This was the worst performing group on Wednesday, dropping about 0.5%, even though yields rose. But I'll talk about that more in just a minute. Recreational services, this was your big industry winner for the day on Wednesday, rose 4.45%. If you noticed, the S&P 500 leaderboard today, you probably saw some of those cruise lines up there. That's your recreational services group right there. So up almost 4.5%. Home construction up 1.25%. I'm going to talk about both these groups in a little bit more detail in just a minute. But we just broke out. This was actually a new breakout to an all-time high on home construction. So again, we're going to go through all that in just a minute. Moving on to the 10-year Treasury yield. This is what I was talking about, up 3 basis points. And you can see that we've now been up the last 3 days. But the financials are back down near their relative lows. I mean, if you look at this chart, for the most part, we go up in yields, financials go up. When the yields start rolling over and coming down, we tend to struggle in the financial area. And then we start to go up again. There's the relative strength. We start to go down, there we go down. But lately, that move up in yields back in November, we didn't really get much of a pop. When we went down, you can see we took another hit to the downside. And now moving back up, we had one decent day, but other than that, on a relative basis, financials have been lagging. So that's been concerning for that group. You have to wonder, what it might take for the financials to get going if rising yields aren't helping. Industrials, which also tend to move up with yields, has been in this downtrend now since beginning of June on a relative basis. Well, you can see the yields went down for a while, but they actually bounced back to the upside. Normally when yields are rising, it's a sign of a strengthening economy. And normally a strengthening economy is good for industrials because we have a lot of transports and things like that in the industrials. And so if the economy is strengthening, you would think areas like transports would do very well, and they normally do. But again, like the financials, industrials on a relative basis have been struggling, even though yields are starting to pick back up again. All right, let's talk a little bit talking technically. And for today, what I wanted to do is just go through these two groups, recreational services and home construction. And let's take a look at a couple of charts here. Now, this is the daily chart on the recreational services group. So this is the $ DJUSRQ, Recreational Services Index. What I wanted to point out is, and if I annotate this, you'll see that the tops coming in, we're going to say right here at about 117.50 and then again up around 120. Multiple tops. I mean, 1, 2, 3, 4, 5, 6, 7. So there's no doubt where we need to eventually get through on recreational services. We've got to get through 120 to really, for this group to begin to strengthen and heal from all the wounds from the pandemic. Until then, we've got to be careful to the downside. I mean, here you can see over the last 52 weeks, we've had, lows down here at about 86, 86, 82 and a half, 83, 86. Here's about 84 and change. Here's another one down around 86. So the support and resistance area, this is marked on the chart. And this is a pretty wide trading range. I mean, from 120 down to just over 80. When you go from 120 down to 80, you're losing 1/3 of the value. When you go from 80 or 82 up to 120, you're gaining roughly 50% value to the upside. So these are big moves. And we saw the big drop, made our way all the way back up, took 4 months to make our way all the way back up to 120. And then in about 3 weeks, 3.5 weeks, we were all the way back down into the 80s again. So there's just not, there's just not been enough business. There's not been enough reopening for cruise lines to really get going yet. Just wanted to point out that we remain in this sideways consolidation period now. Moving on to home builders. So here's a daily chart on the home builders. And here was the high back in May. Here was another high, the 1650 area. That was just under 1650. It was the highest close. Intraday, we got up to 1650, failed. We came back down, hit the 20-day, and now we're breaking back out again. And as we break out in price, you can see the PPO moving back up to set a new high. This group looks really good. And you might think, wow, it's December. Why would home construction be good in December, right? I mean, that's one of the first things I would have thought about. Well, when I started looking at seasonality, one of the biggest surprises for me was looking at home builders over the last 20 years or home construction. Look at how many times November's been higher. 80% of Novembers this century, 60% of Decembers, and 75% of January's higher. These are 3 of the best months of the year. And so if you look at November, the average gain on an absolute basis, that's 2.8 plus 2.8, 5.6 plus 4.5, that's 10.1%. On average, that home construction has gained from November through January. 10.1%, right in the middle of winter. The rest of the year, February, if you add up all these from February to October through the spring, April, you can see is a pretty good month there, 3.9%. But from February to October, the total is 3.3%. So basically, it's April and everything else just balance, offsets each other. All the other months offset one another. So I just think that's kind of interesting, just looking at it. And it, I think, gets back to the point where, the stock market is anticipating what's going to happen down the road. So, I always think of the market, maybe 6 months ahead. Market's thinking about things 6 months ahead, pricing in what's going to happen. And that really makes sense as much with home construction as anything when you look at November, December, and January performance. So I just wanted to point that out. I think that's really interesting. And if we take it one step further and show the relative performance seasonally, this I think is even maybe more impressive. Let's drag this back 20 years. So November averages, the home construction averages outperforming the S&P 500 by 1 percentage point during the month of November, 2 percentage points in the month of December, and 4.7 percentage points in the month of January. 1 plus 2 is 3, plus 4.7 is 7.7%. That's the relative performance. So in other words, home construction averages outperforming the S&P 500 by 7.7 percentage points from November through January over the last 20 years. Do you know what the rest of the year is? When we look across, add all these up, February to October, minus 2.5%. So if you're trying to outperform the S&P 500, pretty much the only time you really, obviously every year is different, but seasonally anyway, the only time you really want to consider home construction is November through January, which we're in. And as I mentioned, we're breaking out. The home construction group just breaking out and showing leadership as it typically does this time of the year. Thought that was pretty fascinating. All right, let's move on to the RRG chart. So RRG, this is the relative rotation graphs. And my good friend Julius de Kempenaar is the creator and founder of RRG. And, I like to use different, I look at relative strength in a lot of different ways, but I think visually the RRG charts are really fascinating. I think they're really easy to visualize. And the main things you have to keep in mind when you're looking at RRG chart is that you've got momentum right here. This is the vertical axis. And then the horizontal axis is relative strength. So when you're moving in this, and we're moving relative to a benchmark, in this case, it's the spider. So I've got all of the different sectors. Now you can see the quadrants: improving, leading, weakening, and lagging. So what you normally see are just this, constant rotation. But at any point in time, you can look and see where sectors are performing relative to the S&P 500. So I think this is really brilliant, because I could use a price relative chart. I can look at the XLC colon SPY, and I can, get a price relative chart. But I can't look at all of them at the same time on that chart using price relative. This way I can look at everything. So I've got the XLC highlighted, and I'll tell you why in just a minute. But let me unhighlight that. And let's just take a look at where we were here. And, and this was back, by the way, in early April. And so what you can do is you can take this and just slide it, and you can really get a good feel. And I'm going to do this fit so that everything fits in here. But you can kind of see, maybe I'll max as well. There we go. So as I'm kind of going across, so here's, May, June, July, and you can kind of just see how every area of the market is performing. Look at that move in energy. So here we are in energy. It looked like we were heading back up into the leading quadrant and made an abrupt turn and went way down, by far the worst performing group as we went, into the latter part of summer. And then look at energy come roaring back all the way into leading. Pretty fascinating to watch all this. So you look where we are right now, and I'm going to highlight communication services. So communication services, I've got 13 weeks as the tail length. And what this is doing is just showing you the stops along the way. So every week, it's just kind of drawing you a little map of where the XLC has been going. And as you can see, it keeps going further down, which means momentum is declining, and also further to the left, which means relative strength is declining. Well, when you're losing momentum and relative strength, you don't want to own it. And that's what the XLC has been telling us. We don't want to be in this. Now, you might think, well, yeah, but it's diversified. It's an ETF. Well, it's really not. The XLC, the two biggest components in the XLC are Facebook and Google, both around 23, 22%. So 45% of this ETF is two stocks. Now, let me go back and I'm going to show you back in March, right about here. So this is the end of March. Look at what the XLC was doing, okay? Now I've got Facebook. So this is back in March right here. So look at what Facebook is starting to do here. March, breaking out above the prior high, and then we get into April. This is Facebook relative to the S&P 500. From March to September, it was awesome. Let's take a look at Google from March to September. So here's Google, March to September, going straight up. So the two components that represent 45% of the XLC were going higher throughout this period. So of course, when we look at the relative rotation graph, we are going to see the XLC doing very well on the RRG. It's in the leading quadrant. It's strengthening. It's moving up, you know, on both the momentum axis, which is the vertical, and then also on the horizontal, which is the relative strength. We're moving up and to the right. That is beautiful. That's what you want to see. However, I want you to go back now and take a look at Facebook. What happened starting in February? Well, here's Google, or starting in September. So Google, for the last 3 months, has lost a little bit of ground versus the S&P 500. Went down, popped back up, and now it's kind of been going sideways. A little bit of a downtrend. Last week and a half, 2 weeks, been coming back up. But overall, I would say there's a little bit of a tilt here to the downside. Well, look at Facebook. The largest holding in the XLC. Look at the relative strength, where we were in September and where we are now. Now, September, you know, this right here is about 3 months ago, which is 13 weeks, okay? So the tail is 13 weeks long. What I want you to do now on this RRG is, as I drag this across over the last, 13 weeks, well, even more than that, but I want you to watch and see what is happening now. Here we're into, April. There's the XLC trying to turn back up there as we go into July, August, kind of hanging around, doing not bad as you would expect. But I want you to look at what's going on now. Here's September. All right, so here we are in September. Now watch from September 13th through the current time. I want you to watch the XLC. See that? So it's losing its relative strength, but it's clear why. We know why. It's Facebook and it's Google. So my point here is, don't rush out and buy the XLC because it's an ETF or, because it's, doing something, a line on the chart. The other thing that I think is really important right now in the XLC is in September, we put in a head and shoulder top. That was the head. So we were moving up. Here's a little neckline. We go back up, we put in the head. We come all the way back down, put in a down sloping neckline, which is what I'm most interested in. I don't like drawing a neckline that's moving higher. And the reason being, if we come down and we break that trend line, we still have key price support levels that we have to negotiate. But here, when you break this neckline, you're not only breaking this low, but you've already broken this low for sure, because you can see it's down sloping. So the down sloping head and shoulder patterns, to me, carry much more weight than an upsloping head and shoulders. I've seen so many upsloping head and shoulders pointed out. They get a little slight breach and then they just shoot right back up again because they never lose the key left side of the neckline support. In this case, they did lose it. But you can measure these patterns from the top of the head down to the neckline. Here, in this case, 7.9%. So once it breaks down, you measure 7.9%. You can see somewhere down around 72.5 is the measurement. Now we got down to 73 and change, and then we bounced, and we've gone all the way back up now, and we're about to test this 20-day EMA. Now, if we can go back through and get back through the neckline resistance, that would be awesome. And then you got the 50-day, you got a lot of things going on this chart. If we could get back through all of that, that would be great. But we're going to need to do something with Facebook. I mean, Facebook's going to have to really start to move back to the upside to get going, to get the XLC going. So if we fail at the 20-day, especially if we get a weak or maybe a hot inflation report on Friday, we may see some of the growth stocks get hit. Facebook, Google, those types of stocks could potentially get hit. If they do, and I'm just saying if, I'm very bullish the market. I don't like to try to predict weakness in the market when we're in a secular bull market, but I want to be aware of everything that's going on. And right now the XLC is the weak area of the market. So if we were to go up, fail at the 20 and start to roll over, just be aware that you do have this measurement that comes in down just above $72. We've got a key low here at 72. We got another, low and breakout around 70, 71. So this area 70 to 72 would make some sense for a potential reversal if we were to get down that low. Now we may just go right back up. Maybe we don't make the full measurement. Maybe the XLC is ready to run, but I think you should at least be aware that this pattern is still in play and it is a bearish pattern. And if we can't get back through the 20-day and that neckline resistance, we could potentially be headed back down to 72, 72.5. All right, let's move on to earnings spotlight. And what I wanted to do here with the earnings spotlight is go over a couple of the companies that reported after the bell today. So the first one I'm going to bring up is GameStop. Now, GameStop, you can see that AD line's been pretty weak. Stock price has been pretty flat, although we had such a huge move. It's kind of messing up the scale here. I mean, we were at 250 not that long ago, had a double top at 250. Now we're back down to 173. So it makes it look like we're not really moving, but this is still, I mean, an 80-point drop from 250 in 3 weeks, 2 weeks. That's pretty significant. But again, it just looks kind of flattened out here on the chart. GME was expected to lose 22 cents. They lost $1.39. Stock's down 3% after hours, which would be roughly about $5. So that'll take it, maybe down to the 167 area, something like that tomorrow, 166, 167, based on where it's trading right now. But the thing I think you have to be careful about with GME is we've been seeing its relative strength. This is GME relative to the specialty retail group. We're down near, 8-9 month relative low heading into the earnings report. And when I see that, I'm not thinking great earnings coming up. And so I'm not surprised when we see a stock like GME actually underperform or not just underperform, but underreport or miss their numbers and then see selling. That's what I would expect when we're not seeing much in terms of relative strength, or in this case, we're seeing relative weakness. Another one that reported after the bell, similar results and also similar relative weakness in play, but this is Phreesia, PHR. So Phreesia was expected to lose 47 cents. They lost 71 cents. Stock was down 6.4% after hours. So it looks like it's about to take another tumble. Notice number one, the AD line. Where are we at? Well, we're down close to the low we had back in May. I mean, we're not far from a 52-week low in the AD line. Let's look at relative strength. Look at the relative strength here versus software. I mean, it is at a 52-week low heading into earnings. Software has been great. I mean, here's software relative to the S&P. You got a great group. And yet, Phreesia relative to the S&P 500 is down near a 52-week low, and it's at a 52-week low relative to its peers. So Wall Street doesn't want any part of this company. They go out, they meet with management teams. When you see relative strength this week, you've got to have questions running through your mind. do I really want to be holding this stock into earnings? You know, what does Wall Street know that I don't know? Those are the things I'd be asking myself. I would never hold a stock into earnings that looks like this. I don't care if it gaps up or not. When I get something like this, I'm expecting potentially the worst. So PHR getting hit a little bit after hours, 6.4%. You want to see another one? How about this one? CURV. Now, this is a fairly new company. They went public back at the end of June, but you can see after getting up above $32, $33 in August, went down, bounced a little, and has been going down. AD lines, yeah, kind of flat coming across here. It's been not bad last month or two, but since it went public, it's pretty flat. But relative strength, down near 52, well, it's only been out for about 5 months, so let's just call it a 5-month relative low. It's very close to its lowest level relative to the apparel retailers. Well, you can see the apparel retailers recently set a 52-week low versus the S&P 500. So apparel retail has not been a great group to be in, and this stock is a bad stock relative to the group. So what do you think, how the market might react when they come out with their earnings? They actually beat their earnings, by the way. Now, I don't know, I didn't see the rest of their report, but they posted earnings per share 25 cents. Market was expecting 22 cents. After hours, the stock's down 25%. So, I can't tell you what the earnings are going to be, but I know when I see a stock that is out of favor, Wall Street wants nothing to do with it. I want nothing to do with it. I feel like when you're following relative strength and you're following the charts, you're actually putting a lot of these Wall Street MBAs to work for you. You're allowing them to tell you what you can expect. Now, I'm going to give you a couple more reports that I think they're going to come out with earnings here, I think tomorrow after the close. But look at these charts. Now, the first I'm going to show you, I think this is going to be a great report. I can't promise you it's going to go higher, but I think it's going to be a great report. Look at the AD line. I think there's been a lot of accumulation in Costco. And then look at the relative strength. Just 10 days ago, I mean, it's been going straight up on a relative basis versus its peers, straight up versus the S&P 500. All we're doing is getting a little bit of sideways consolidation. We're seeing a little pullback here. I think you're going to get big numbers. If I had to bet on it, I think it was going to gap higher. We'll see what happens. It's run up a lot. Some of it may be priced in, but I think you're going to see a really good report with Costco. Now, ones I'd be careful about, I'm going to go through these pretty quickly. Chewy, AD line weak. Look at the relative strength. They report tomorrow. Been a very, very poor performer relative to its specialty retail peers. And then one last one, Hormel. This is in the consumer staples area. But look at Hormel, AD line, horrible. Relative strength down near low, and its industry group, 52-week low relative to the S&P. I think you got to be careful. All right, last thing, 3 you must see. Let's take a look real quick. KHC, I think it's downtrending. It's below its 20-day. Volume trends are weak. I think this is a stock that you really want to be careful with. Target, another one, just gapped down below the 20. It's now trending below its 20-day. PPO's gone negative. This is a far cry from what it was doing before. I think you got to see one of two things happen before I'd be interested in Target. Either hit a major support like the low in October or get back up above that 20-day with some volume. Until then, I have no use for Target. And last one, Roku. Big day for Roku, up $39, 18% on Wednesday. Got back through its 20-day. I think got some issues up here around 280 to 300. I think we can get there. After that, we got to be a little careful. All right, that's it for me. I appreciate everyone tuning in. You can join me again next week on Monday over at earningsbeats.com for your next episode of Trading Places Live. Have a great day. Have a great weekend, everybody. See you next week. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.